Really the best way to figure out what's going on with mortgage interest rates is actually to look at the Treasury 10-year yield. And you can see here how volatile it's been over the last 5 years. Right now, we're at the 10-year Treasury yield is at $3 and 3.26, and that's high for the year. And not surprisingly, interest rates are about to cross 6%. And so every day when I wake up, I look at the Treasury yield because that gives me an indication as to what's going to happen with rates for that day. And if you look here, let's just take a 2-year history. You know, so in 2020, the Treasury yields got so low, but we never figured out exactly how low interest rates could get. Because in general, like a really, really crude way to say, okay, what is the going 30-year fixed mortgage rate would be to add like 2 percentage points to the Treasury 10-year Treasury yield. So if it's at 3.26, you can say, okay, its mortgage rates are roughly 5.26 or 5.25. And then when the treasury yield got down to like 0.69 or zero point 0.5, we almost didn't even see how low rates could go because there was so much demand. Lenders didn't have to lower their rates, so they were earning more margin. So it was, there was a time like if rates were to stay at that level, you could have seen 30-year fixed rates under 2%, which we never really saw. The lowest we saw on a 30-year fixed rate was 2.25. We saw 15-year fixed rates go down to 1.75. But anyways, I just wanted to kind of point out what mortgage professionals are looking at. They're looking at this 10-year yield. You can see today the 10-year yield went down. So if we do a 5-day, so interest rates went up. This was yesterday, and then this is where we are yesterday, and then interest rates went down, or 10-year yields went down, and mortgage interest rates corresponded with this. So like today, mortgage interest rates they dropped. They actually reposted right there. So what that means is the lender midday decided to lower their interest rates again with the Treasury yield dropping. And so again, this is a very elementary way to see what's going on because ultimately lenders are going off by what the secondary market will pay for. But what the secondary market will pay for is dependent on the Treasury yields. And then also lenders have to factor in their own margins. That impacts the pricing that they offer as well. So just wanted to kind of share that nugget of information for you, how mortgage professionals are thinking about the Treasury yields and how it relates to mortgage rates.